Most of us were taught to work hard, avoid debt, get a stable job, and save money. It sounds safe, but today, it's failing. Wages lag behind inflation, jobs are disappearing, and money doesn't work like it used to. The wealthy don't follow these rules. They focus on assets, cash flow, and understanding how money really moves. That knowledge, financial education, is the real divide between the rich and everyone else. The problem is not hard work, it's financial blindness. Most people believe that financial success comes from effort. Work harder, get promoted, earn more, save more, retire later. But effort alone doesn't explain why two people with similar incomes can end up in completely different financial realities. One struggles paycheck to paycheck, the other builds wealth quietly, even during economic chaos. The difference isn't intelligence or ambition, it's how they think about money. Schools teach academic knowledge, not financial strategy. Students graduate knowing calculus, literature, and history, but almost nothing about income types, assets, liabilities, cash flow, or how banks actually evaluate wealth. As a result, most people grow up chasing income instead of building systems that generate it. The 3 types of income, and why only one creates freedom. Number 1. Earned income. Earned income is what most people rely on. It's money earned from a job or self-employment. You trade time for money. The harder you work, the more you earn, up to a limit. This is also the income that gets taxed the heaviest. Income tax, payroll tax, social contributions. By the time the money reaches your bank account, a large portion is already gone. Most people spend their entire lives here, believing that a higher salary will eventually solve everything. It rarely does. Number 2. Portfolio income. Portfolio income comes from selling assets at a profit, stocks, businesses, real estate flips, or other investments. This income is taxed less than earned income, but it still depends on timing and market behavior. It requires constant decision-making and often emotional discipline. Many people mistake this for investing, but it's closer to trading. While portfolio income can create wealth, it's not where the ultra-rich focus their energy. Number 3. Passive income. Passive income is money that continues to flow without requiring constant labor. Rental income, business cash flow, royalties, and certain structured investments fall into this category. This is where wealth compounds. Passive income is often taxed more favorably, sometimes deferred, sometimes offset by deductions. More importantly, it doesn't require daily effort once the system is built. The wealthy don't aim to earn more money. They aim to control assets that produce cash flow. Why the rich don't chase jobs. For decades, getting a job was considered safe. Today, that assumption is collapsing. Automation, artificial intelligence, outsourcing, and algorithmic management are reshaping labor markets at unprecedented speed. Jobs that once felt secure are disappearing or becoming unstable. Yet schools still prepare students for employment, not ownership. A job depends on external approval. Someone else decides your salary, someone else decides your future, and someone else can remove your income overnight. From a financial perspective, that's not stability, it's exposure. The wealthy understand this. That's why they build income sources they control. Debt isn't the enemy, ignorance is. Most people grow up hearing the same financial warnings on repeat: stay out of debt, pay everything in cash, and eliminate loans as fast as possible. This advice sounds wise because it protects people from mistakes, but it also hides a critical distinction. Not all debt functions the same way. There is a profound difference between debt that consumes your future and debt that expands it. Consumer debt is designed to extract value from you. Credit cards, personal loans, car financing, and lifestyle upgrades usually buy things that lose value the moment you own them. These debts demand payment without producing income in return. Over time, they reduce flexibility, increase stress, and lock people into working longer just to maintain the same standard of living. Strategic debt works in the opposite direction. It is used to acquire assets that generate cash flow, rental properties, businesses, productive systems, or income-producing investments. When structured correctly, the asset itself services the debt. In some cases, it does more than that. It produces surplus income after expenses, interest, and taxes. This is how real estate investors, business owners, and large institutions operate. Debt becomes leverage, not a liability. The risk doesn't disappear, but it becomes measurable and manageable. Without financial education, debt destroys people. With education, discipline, and structure, debt becomes one of the most powerful wealth-building tools available. Why taxes feel unfair, and why they're designed that way. Many people assume the wealthy avoid taxes through tricks, loopholes, or unethical behavior. While abuse does exist, the deeper reason taxes feel unfair is structural, not conspiratorial. Modern tax systems are built to incentivize certain behaviors and discourage others. Earned income, wages, and salaries is taxed heavily because it represents individual labor, not scalable economic growth. Governments can reliably tax it because it is visible, predictable, and easy to track. That's why employees feel the tax burden most intensely. Asset-based income operates under different rules because it fuels long-term economic activity. Investment in housing, infrastructure, businesses, and development creates jobs, expands supply, and stabilizes systems. To encourage this behavior, tax codes offer deductions, deferrals, and preferential treatment. The system isn't fair, but it is consistent. Those who rely entirely on wages fund most public revenue. Those who own assets operate in a parallel framework. Understanding this doesn't mean endorsing it, but ignoring it guarantees permanent disadvantage in a system that quietly rewards ownership over labor. Why long-term investing advice is failing a new generation. Traditional financial advice often promotes long-term investing in diversified portfolios, stocks, bonds, and funds held for decades. While this strategy worked in a slower, less automated economy, modern markets operate at machine speed. High-frequency trading, algorithmic dominance, and monetary expansion have changed the landscape. Holding assets blindly while currency is continuously devalued exposes savers to silent loss. This doesn't mean investing is useless. It means passive investing without understanding cash flow, inflation, and risk management is increasingly fragile. Wealth today requires awareness, not autopilot. The real risk isn't the investment, it's the investor. People often ask, is real estate risky or is business risky? The better question is, who is taking the risk? An uninformed person makes any investment dangerous. An educated person reduces risk by understanding structure, numbers, and downside scenarios. Risk isn't eliminated by avoiding assets, it's transferred to employers, markets, institutions, and governments. Financial education turns uncertainty into calculation. Why schools don't teach this? Most schools prepare students to be employees, not capitalists. They focus on grades, resumes, and credentials while ignoring balance sheets, cash flow statements, and asset evaluation. Students graduate knowing how to apply for jobs, but not how banks assess financial strength. They learn how to pass exams, not how money moves. As a result, people spend decades working without understanding why they feel financially stuck. The education system isn't malicious, but it's incomplete. The mental shift that changes everything. The turning point for wealth creation is simple but uncomfortable. Stop focusing on income and start focusing on assets. Income follows assets, not the other way around. When someone stops asking, how do I earn more, and starts asking, what produces cash flow, everything changes. This shift doesn't require massive capital. It requires curiosity, education, and long-term thinking. Wealth isn't built by earning faster. It's built by owning smarter. Money rewards understanding, not effort. The world doesn't reward hard work equally. It rewards those who understand systems. Debt, taxes, income, and assets aren't moral concepts. They're financial tools. Used blindly, they cause damage. Used intelligently, they create leverage. The biggest risk today isn't investing. It's remaining financially illiterate in a system that runs on money logic you were never taught. Financial freedom doesn't begin with money. It begins with education. If this changed the way you think about money, debt, and risk, imagine what understanding the system can do for your future. Wealth isn't about working harder. It's about seeing what others were never taught to see. If you want more breakdowns like this that actually make you smarter about money, like and subscribe.